Hello, good morning, my finance warriors. So hope your Sunday started well, and it's going to be even better. We're going to be together on our study session, which I believe is study session number 6. So today we're going to talk about short selling and options. Let's just wait a few seconds so everybody can join in. All right. Again, for those of you who don't know me, my name is Chris Manfre. I'm one of the lead instructors at the American Institute of Finance, and we're having this weekly or bi-weekly study sessions talking about some of the most important aspects of finance. So as you might recall, if you joined before, we talked about investing in stocks, we talked about investing in bonds, and so today we want to touch upon short selling and options. As you know, this sessions last for 30 minutes, so they're fairly short. And so stick around. I'm going to show you today actually how to place an order to buy or sell an option. All right, so let's get started. Short selling. What is short selling? You probably heard of it. Maybe some of you know what it is. But basically, we're betting against the market. Sorry. We're betting against the market. So what that means is that if we think that the market overall or a particular index or one particular stock is going to go down, then we're going to short sell that particular security. So we hope, right, in that situation that the stock or index will go down. Remember that when you invest in the stock market, you always have a point of view, right? You have a view about the market. And it must be so. Don't think that everybody has the same view on a particular stock or position or index, because otherwise there would never be on the other side anybody to the opposite of what you're trying to do. So if you're short selling, that means that your point of view is that the stock or the index will go down, and obviously on the other side there must be somebody who has the exact opposite view, right, for that particular stock. Now, be careful, because short selling can be very dangerous. I say dangerous, I should say very dangerous. Why is that? Well, because as we know, the market has been going up. As far as we know, right, there is a drift, there is a positive bias, meaning that the stock will drift up over time, right? So if you bet against the market, it is very likely that you're going to lose money, right? So you have to be very careful about when you do short selling. So there are hedge funds that actually specialize solely in short selling, right? And that requires typically to have very strong skills in accounting, right, in financial analysis, so that you can look at a particular company that you think is going to do poorly going forward. I can tell you that, for example, Tesla right now, there are a lot of short sellers, right, that are betting against the company, and so that might expedite, I would say, the drop if, for example, the stock starts going down. Okay, this is just the premise, but what is it really short selling? Well, taking a short position or short selling entails the following, and let me see if I can actually help with the visual with my pen. All right, let's try this. So we're here on the left side of the screen. So you're the short seller. All right, you're here. What are you going to do? You're going to borrow stock that you don't have. So when you short sell, you actually borrow stock that you do not have in your portfolio. Okay, and you borrow it from somebody who actually owns the stock, right? Could be a broker, very likely, that owns the stock or has somehow that stock in its inventory. Then you're going to go ahead and you're going to sell the stock. You're going to sell the stock in the marketplace, right? And you are going to receive cash. You're going to receive cash. So you're going to see cash in your account. And by the way, yes, you issued an IOU to the stock owner, because you said, you know what, stock owner, I owe you that stock, right? And I will pay it back at a certain point. right? And sometimes there is no expiration for this contract, right? As long as things are going the right way, let's put it that way, you can hold on that stock that you borrow from the stock owner. So this is at the beginning. We call it time zero. Now, let's say that we are going to get to a point where we actually want to cover a short position. We want to close a short position. So what are we going to do? Well, we're going to buy back the stock. You can see here, you buy back the stock, right? And then you're going to return the stock, right? You're going to return the stock. So that's what happens. How do you make money? Well, for example, I mentioned Tesla. By the way, it's just an example. So I don't certainly encourage you to short Tesla or any other stock in particular. But you know, if Tesla is at 1,650 approximately, right? Let's say that you're going to borrow the stock, you sell the stock for 1,650, and so you collect the cash. Let's say just on one share, right? Now, let's say that now the stock is going to drop and it's going to go, sorry. Okay, pan, yeah. The stock is going to go to just $1,000, right? At that point, you're going to buy it back for $1,000. So you can see immediately that you're running a profit, right? You're running a profit because now you bought for $1,000 something that you sold for $1,650, and that's how you make money. Okay, so that's all on short selling. Just wanted to run it through that quickly to explain what that is and how you can actually run a profit. Again, be very careful about short selling because remember, the market is a positive drift typically, so it tends to go up. So you have to be very sure about shorting a position if you want to actually run a profit on your stock. All right, so having said that, I'm going to go to the next slide and we start talking about options. Okay, options. What are options? Options were born in the 70s, right? And so, you know, over 100 years ago, basically there were no options, but now we do have options, right? They were born in the 70s. And what are options? Well, options are just contracts between a buyer and the seller. And as we will see, this contract gives us an option, right? As the name suggests. And how can we use options? And sometimes there is a misconception about options because we might think it's just, you know, highly speculative, but it is not. It is not true. In fact, options can be used for investing. They can be used for speculation, if you like, and they can also use as an insurance, right? And so we'll talk a little bit about how you can use options for your portfolio as an insurance. Now here you see option types. So essentially, there are two types of options. Remember this, because you know there are much more complex types of derivatives. You know, options belong to the family of derivatives, and so in order to understand, you know, exotic derivatives, more complex derivatives, we typically need to start with options. And so if we have a strong understanding, a solid understanding of options, then maybe we can graduate in a sense and start looking at more complex types of derivatives. So we need to make sure we understand calls and puts. So again, there are two types: calls options and put options. Options can be bought and sold. So what that means is that we have four possible situations, because we can buy a call and sell a call. We can buy a put and sell a put, okay? So remember that, and we're gonna look at both sides, right? You can buy and sell yourself, and we're gonna look at both sides for why we would do what we do, right? Buying or selling one of these options. Remember that an options entail a zero-sum game. What does that mean? game theory refers to zero-sum games, right? So zero-sum game means that either we gain or we lose, and the other side will be in the exact opposite situation. So if you are on the other side of the transaction and I gain, very likely, actually for sure, you will lose, and vice versa. Okay, so we cannot both gain, unfortunately, and we will not both lose. Okay, so something to remember about options. So let's look at a call option first. So first we're going to look at calls, and then we're going to look at puts, okay? And as I mentioned towards the end of this session today, I will show you how you can look at options in your brokerage account. So a call option, the buyer. A call option gives the owner, the buyer of the option, the right, but not the obligation. And this is the key word or words, not the obligation to buy one share of stock from the issuer of the call. So again, when we hear these words, we get confused very quickly. But again, imagine there is this contract. You can buy, right, this option from the seller. This gives you a right, but not the obligation to do something. And specifically, it gives you the right to buy a stock, right, at the particular price, by the way, and that's the benefit of the option. What is this particular price? Well, we call it the exercise price or the strike price. I prefer to call it strike price for whatever reason, but you can call it either way. So that's the price at which you will be able to buy the underlying stock. So as you can see here immediately, we have an underlying asset, an underlying security, right? And then we have a security that is derived from that underlying asset, right? So that's why we call it, by the way, derivative, because the value of the option comes from the underlying security, which is a stock, an index, an ETF, etc. Okay, so the owner of the option will exercise it if the stock price is only above the exercise price. Okay, let me say that again. Again, you will exercise the option only if it's convenient to you, if it makes sense, if you make money out of it, right? And so that's why you have the right, but not the obligation to do so, right? And so remember that in order to gain this right, you actually have to pay, right? You have to pay the seller of the option, and we call that payment premium, right? A premium. So right away, as you buy a call, you have to pay a premium, and therefore, right, there is a little bit of an expense, let's put it that way, right off the bat, right? You have to buy this contract, and therefore you have to pay for it. But again, you're going to pay a small amount, right, initially, so that gives you the ability to do something on a much larger scale. Okay, so what is the other side? I told you there are different views, right? So if you're buying an options, it must be that somebody is actually selling you an option. So we call this the option writer. So when you write an option, there's another word to say that you are actually selling the option, right? So writing an option is the same as selling the option. And so the seller of the option actually will receive the premium, right? We said the buyer before would pay the premium. So that means that the seller will receive the premium. And the seller very likely does it exactly because of that reason, because the seller wants to collect the premium. Okay. Now, remember that there are two possibilities when you sell an option. You can sell it covered, or you can sell it naked, right? So they're, again, covered and naked. This is the lingo of options, okay? So covered, it means you actually have the underlying security in your portfolio. Naked, it means you don't have it, which means you would have to then go and buy it in the marketplace. Okay, but let's look at an example, because it's easy to get lost when we talk about options. And by the way, if options appear to be complex, don't be intimidated. It's just a matter of practicing, okay? And little by little, right? Maybe you start just by going along a position, a stock that you like, and then as you learn, as you work on your finance education, you will feel more comfortable than doing something a bit more advanced, like buying an option or selling an option. So let me walk you through this example. So an investor buys a call, I call it ABC Inc., any stock you can think of, and the stock is trading at $10 per share. So let me see if I can actually use my pen. Okay, so this is the price. This is the price of the underlying asset. Okay, so the buyer of the option, which could be you, pays 50 cents to buy the option, and this was the premium. We call it the premium. The strike price is $12. So again, right now the stock is trading at 10. You buy this call. You pay 50 cents for it, right? And the contract, the call option, gives you the right to buy the underlying stock at $12 per share. You might say, well, that doesn't sound very smart, right? If the stock is trading at 10, why would I want to buy it at 12? Well, that's the point. Let's say that now the price is going to move. And so case one, right? Let's see what happens. Let's say that the price goes to 14. Now you see it makes sense because you can buy it for $12 per share, and the price is at $14 per share. So the buyer pays $12 per share, sell it in the marketplace for $14 per share. And what is your gain? Well, you make $2, right? $2 right there and then, right? $2. You paid 50 cents initially to have this right, which is the premium. So that means that you're left with $1.50. $1.50 will be your profit. Now you understand, based on this example, that what you want when you buy a call is for the price to go up, right? You want the price to go up. If the price goes up, you locked in, right, the price at which you will be able to buy the security, the underlying security. Okay. You can also understand that the seller of this call will want ideally the price of the stock to go down or don't move, right? It can also stay around $10 per share, and the seller of the call would be perfectly fine. Now you can see that if you make $1.50, the seller of the call will lose $1.50, right? I told you that in this particular types of transactions, it's a zero-sum game. You remember, right? I said it just a few minutes ago. It's a zero-sum game, which means what I lose, you gain. What you gain, I lose. Okay? All right. So this was the case where the price per share actually increases after I purchase the contract. But let's look at case two. Now, let's say that the price per share is actually going to drop, right? And here I put 10, but I would like actually this to be 8. Well, 10 is fine. 10 is fine. Well, let's put 8. I didn't want to put 10. Let's say that it goes to 8, or it stays at 10. It doesn't really make a difference, as you can understand. So if that happens, basically, you're not going to exercise your call, right? It makes no sense if the price stays at 10, or it goes to 8, or it goes to 7, right? So basically, it doesn't make sense for you to do anything. You cannot, you're not going to exercise your call, right? So therefore, you are going to lose the 50 cents that you paid initially, right? The premium that you paid, the 50 cents, and the seller is going to gain the 50 cents, right? He's going to gain the 50 cents. Again, this happens if the price is 10, 8, 11, right? Et cetera, et cetera. So there are many possibilities where you just spent 50 cents and the seller gained 50 cents. Okay. You know, since we have only 10 minutes left, right? What I would like to do is to actually go and show you an option chain in a real brokerage account. I promised you I would look at that, right? So let's do that. let's go to the brokerage account. And then we might come back here. Okay, so this is actually my brokerage account, and this happens to be TD Ameritrade, and you can have another brokerage account, whatever you like. So when you look for a particular security, and in this case, I'm looking at SPY. So basically, this is the ETF, exchange traded fund for the S&P 500. So let's say that I want to trade an option for the SPY. So I go here, you will see whether it is TD Ameritrade or another type of brokerage account, you are going to see option chain in some fashion on your page. So let's click on it. Somehow it's not showing it. Let's see. Okay. There you go. So when you click on that, what you see is basically different, you see the option chain, right? Now let me click on minus there. So let me explain first here what's going on. So you see a lot of dates here on the left hand side of the screen. And so that refers to when the option is going to expire. SPY specifically is very interesting because it has lots of expiration dates. As you can see, there are bi-weekly options. So we have actually Monday, Wednesday, and Friday. We have an expiration for those days every week of the year, which is fairly interesting. So let's say that we want to select an option that will expire next Friday. Okay, so we can go August 21st, 2020. So we can click here on the plus, and now you're going to open the chain. Okay, so look at this. Now, let me help you, let me guide you through all this panoply of numbers here. So here, what you see in the middle is the strike. Okay, what you see in the middle is the strike. And the strike is the price at which you can buy the underlying security. Now you can see that in the middle we have $336, right? Let me see if I can actually use my pen to point that out. All right, $336. And that means that very likely the price currently is around that price. In fact, it was, because last Friday the SPY closed at 336.84 cents, I believe. So that is the price of reference in a sense, right? So you see that it divides basically the colors of the option chain. So now you can see you can select a strike price that you like, knowing that 336 is very close to the current price. So let's say that you want to select a price that is 339, right? Now let's say you want to buy the option, right? If you want to buy the option, let's say you want to buy a call option. Now you look at, you see that here we have calls and puts, okay? So if you want to buy a call, you're going to look at this, right? And you can see that you can basically buy the call for $1.38, okay? You can buy for $1.38. Now, what does that mean? Well, again, we're putting in practice what we learned just a moment ago by just looking at the slides and looking at the theory. So what happens there, you're paying a premium. The premium is $1.38. To do what? To have the right, but not the obligation, to buy the SPY at $339 per share, right? Now, you're asking probably, and please, if you have questions, just type it in the appropriate box and I'll be happy to address your questions. But the question that might come up is, well, why would I be interested in buying at 339 if currently it's trading at 336? Well, the reason is because the price can go a lot higher, right? It could go a lot higher. So imagine the situations where the price is going to shoot up, right, and go to, for example, 345, right? If it goes to 345, then you are going to have the right to buy for what? 339, right? So you're going to make $6 on that particular trade, because now you locked in the price at which you actually have the right to buy that particular security. Okay, so that's the idea. That's how it works, and so you can select the price that you like, that you think is more appropriate, of course, based on your analysis, and you will pay the appropriate premium. Please notice that the closer the price is to the current price, the higher you pay for the premium. And that makes sense if you think about it, right? It makes a lot of sense because it's very likely, it's very possible that the price of that security will go above, for example, 337, right? It could go through 339, right? And you would make some money right away. So you can see that what you pay is actually increasing the closer you get to the current price per share of that particular security. Now, if you look at, so I was looking at the ask column, okay? You can see here was the ask column that I was referring to. You might wonder, what's the bid column, right? What's the bid column? And the bid column is if you were to sell that particular call, okay? If you were to sell it. So you see that actually you would receive less than what the buyer actually pays. That's because there is the house, so to speak, right? The brokerage firm, in essence, is the house and is collecting the bid-ask spread, right, from the buyer and the seller of the option. It looks like there is a question. Oh, can anyone sell calls or puts? That's a great question, because we think of this as something a little esoteric, and yes, anybody can do it, right? You typically need to ask your brokerage account, your brokerage firm, to do so. So you have to fill out a form typically and express your intentions and your objectives as an investor, and then you will be approved by your brokerage firm. Okay, so the idea is that they just want to make sure that you know what you're doing, since options are a little more complex than just going along a particular security or even shorting a security. So once you're approved, you have the ability to buy and sell options. Okay. Again, initially you can think of just doing something very simple. You can buy a call, right, and that will give you the ability to benefit and profit from it if the price of the security that you selected is going to go up. Now, the downside of buying a call is not that huge, because all you're going to lose is the initial premium that you're paying. Okay, so that is all that you can lose in essence, and there are some benefits if there could be potentially great benefits if the price per share is going to go up. So buying the option is less risky than selling an option. So before you start selling options, you should really make sure that you understand the underlying dynamics of the way options actually work. All right, guys, it looks like we're at our limit here. So time flies when you have fun playing with options, I guess. So we'll consider actually extending this session and talking a little bit about options also next time, since we did not have a chance to talk about the value of options or put options for that matter. So anyway, invest safely, have fun with finance, and I will see you next time. Thank you for attending.